Welcome to Beyond the Surface. I'm excited to delve into gold as an investment, a topic that's fascinated us for ages. With inflation on the rise globally, gold's appeal is undeniable. This metal's journey from ancient times to its role in today's economy showcases its lasting value and allure. In this video, I'll guide you through gold's economic significance, its history as wealth and currency, and its role as a safe haven in uncertain times. We'll look at different ways to invest in gold, from physical pieces to ETFs and stocks, and examine what drives its price. Join me as we uncover why gold is a crucial part of a diversified portfolio, offering protection and growth opportunities in today's volatile economic climate. Let's embark on this glittering exploration together. Gold, a precious metal that has captivated humanity for millennia with its mesmerizing luster and rarity. From adorning ancient Egyptian pharaohs to serving as the foundation of entire monetary systems, gold's allure has endured the test of time. Today, as economic uncertainty looms large with inflation rates soaring to 40-year highs, investors are once again turning to the timeless safe haven of gold. In modern investment portfolios, gold plays a multifaceted role. It serves as a hedge against inflation and currency fluctuations, a diversification tool to mitigate risk, and a tangible store of value in times of geopolitical turmoil. Gold's unique characteristics and historical performance have solidified its position as a strategic asset in the eyes of both individual investors and central banks alike. In this video, we will embark on a comprehensive exploration of gold as an investment in the current economic landscape. We'll delve into the fundamentals of gold, examining the factors that influence its price and the various ways investors can gain exposure to this precious metal. From physical gold in the form of bullion and coins to gold ETFs, futures, and mining stocks, we'll cover the pros and cons of each investment vehicle. Furthermore, we'll analyze gold's performance in different economic scenarios and its correlation with other asset classes. By examining historical data and trends, we'll uncover the potential benefits of including gold in a diversified investment portfolio, particularly during times of market volatility and economic uncertainty. We'll also address common misconceptions and objections surrounding gold investment, providing a balanced perspective on the risks and rewards associated with this age-old asset. Finally, we'll offer practical insights and strategies for investors looking to incorporate gold into their portfolios, taking into account individual risk tolerance and investment goals. So, whether you're a seasoned investor seeking to hedge against inflation or a novice looking to diversify your portfolio, join us as we unravel the enduring allure of gold and its role in modern investment strategies. Get ready to discover the glittering potential of this timeless treasure. When it comes to investing in gold, there are several key fundamentals that every investor should understand. At its core, gold investment involves allocating a portion of your portfolio to this precious metal with the aim of diversifying your holdings, hedging against inflation, and potentially generating long-term returns. One of the most straightforward ways to invest in gold is through physical ownership. This entails purchasing gold in the form of bullion, coins, or jewelry. Physical gold provides investors with a tangible asset that they can hold in their hands, offering a sense of security and control. However, it's important to consider the costs associated with storing and insuring physical gold, as well as the potential challenges in verifying its authenticity and purity. For investors seeking a more convenient and cost-effective way to gain exposure to gold, gold exchange-traded funds (ETFs) have emerged as a popular alternative. Gold ETFs are investment vehicles that track the price of gold, allowing investors to buy and sell shares on stock exchanges, just like they would with traditional stocks. These funds are backed by physical gold holdings, providing investors with exposure to the metal without the need for direct ownership. Gold ETFs offer liquidity, transparency, and lower transaction costs compared to buying and storing physical gold. Another avenue for investing in gold is through gold mining stocks. These are shares of companies that are engaged in the exploration, extraction, and production of gold. By investing in gold mining stocks, investors can potentially benefit from the growth and profitability of these companies, as well as any increases in the price of gold itself. However, it's crucial to recognize that gold mining stocks are subject to additional risks, such as operational challenges, geopolitical factors, and fluctuations in production costs. For those seeking a more diversified approach, gold mutual funds offer exposure to a basket of gold-related assets, including mining stocks, ETFs, and physical gold. These funds are managed by professional portfolio managers who make investment decisions on behalf of the fund's investors. Gold mutual funds provide a convenient way to access a broad range of gold investments while benefiting from the expertise of experienced managers. However, it's important to consider the fees associated with these funds and to carefully evaluate the fund's investment strategy and track record. In summary, gold investment encompasses a range of options from physical ownership to ETFs, mining stocks, and mutual funds. Each approach has its own advantages and considerations, and the choice ultimately depends on an investor's goals, risk tolerance, and personal preferences. By understanding these fundamentals, investors can make informed decisions when incorporating gold into their portfolios and navigating the dynamic landscape of gold investment in the face of economic challenges like inflation. Throughout history, gold has held a unique and revered position in human society. Its intrinsic value, scarcity, and the ease with which it can be melted, formed, and measured have made it an ideal medium for trade and a store of wealth. Ancient civilizations, from the Egyptians to the Romans, recognized gold's value, using it to craft jewelry, coins, and other artifacts that symbolized wealth and power. As societies evolved, gold's role as a currency solidified. It became the backbone of global economies, with nations adopting the gold standard, a system where a country's currency value was directly linked to a specific amount of gold. The gold standard ensured that the economic value of a currency was stable and universally recognized, facilitating international trade and investment. However, the 20th century brought significant changes. The financial demands of World War I and the Great Depression tested the gold standard's viability, leading to its eventual abandonment. By the mid-20th century, most countries had transitioned to fiat currency systems where the value of money is not based on physical commodities but rather the government's declaration that it has value. This transition marked a new era for gold. No longer the basis of currency, gold emerged as a powerful investment asset. Investors began to see gold as a hedge against inflation and currency devaluation, a safe haven in times of geopolitical and economic uncertainty, and a diversification tool for their portfolios. The shift from the gold standard to fiat currencies increased gold's appeal as an investment, as its price was no longer fixed to currency values but could fluctuate based on market demand and supply. Today, gold continues to be a sought-after investment, with its historical significance as a store of value and its proven ability to withstand economic downturns reinforcing its status. The transition from a currency underpinning to a valuable investment asset has only broadened gold's appeal, making it a timeless component of investment strategies worldwide. Gold, often seen as a safe haven in times of economic uncertainty, is subject to a complex interplay of market forces that shape its price. In this segment, we'll dive into the key factors influencing the price of gold and explore the intricate relationship between the precious metal and crucial economic indicators. One of the most significant drivers of gold prices is the state of the global economy. During times of economic turmoil, investors often flock to gold as a hedge against inflation and currency fluctuations. When confidence in traditional financial markets wavers, the demand for gold surges, pushing prices higher. Conversely, when the economy is thriving and investors are more risk-tolerant, the allure of gold may diminish, leading to a decrease in its price. Inflation, the silent thief that erodes the purchasing power of money over time, plays a vital role in the gold market. As the cost of goods and services rises, the value of paper currencies tends to decline. In such scenarios, gold emerges as an attractive store of value as it maintains its intrinsic worth regardless of inflationary pressures. History has shown that during periods of high inflation, gold prices often soar as investors seek to protect their wealth from the ravages of rising prices. The relationship between gold and currency values, particularly the US dollar, is another crucial factor in the gold market. Gold is primarily traded in US dollars, which means that a stronger dollar can make gold more expensive for buyers using other currencies, potentially dampening demand. Conversely, when the dollar weakens, gold becomes more affordable for international buyers, stimulating demand and pushing prices higher. This inverse relationship between the dollar and gold adds an extra layer of complexity to the market dynamics. Interest rates, the cost of borrowing money, also have a significant impact on gold prices. When interest rates are low, as they have been in recent years, the opportunity cost of holding gold decreases. Investors are less incentivized to park their money in interest-bearing assets, making gold a more attractive alternative. However, when interest rates rise, the appeal of gold may diminish as investors seek higher yields elsewhere. It's important to note that while these economic indicators influence gold prices, the relationship is not always straightforward. Geopolitical events, supply and demand dynamics, and investor sentiment all contribute to the intricate dance of the gold market. As we navigate the current economic landscape, marked by rising inflation and shifting monetary policies, understanding these complex relationships becomes more crucial than ever for investors seeking to make informed decisions. When it comes to building a robust investment portfolio, understanding the performance of various asset classes is crucial. In this segment, we'll take a deep dive into gold's performance over the past decades and see how it stacks up against other popular investment vehicles like stocks, bonds, and real estate. Gold has a reputation for being a reliable store of value, but how has it actually performed over the years? Let's take a look at the numbers. Over the past 50 years, gold has delivered an average annual return of around 10%, outpacing inflation and providing investors with a solid hedge against economic uncertainty. During times of market turmoil, such as the 2008 financial crisis and the recent COVID-19 pandemic, gold has proven its mettle, often surging in value while other assets faltered. But how does gold compare to other asset classes? Let's start with stocks. Over the long term, stocks have generally outperformed gold, with the S&P 500 delivering an average annual return of around 11% since 1970. However, the stock market is known for its volatility, with sharp downturns and periods of heightened uncertainty. Gold, on the other hand, tends to be less volatile and often moves independently of stocks, making it a valuable diversification tool. Bonds, often seen as a stable and low-risk investment, have also played a significant role in investment portfolios. While bonds typically offer lower returns compared to stocks and gold, they provide a steady stream of income and can help balance out the volatility of other assets. In recent decades, bonds have delivered an average annual return of around 5 to 6%. However, in the current low interest rate environment, the appeal of bonds may be diminished, making gold an attractive alternative for investors seeking stability and potential growth. Real estate, another popular investment avenue, has its own unique set of characteristics. While real estate prices can vary greatly depending on location and market conditions, over the long term, real estate has generally appreciated in value. In the U.S., home prices have risen by an average of around 4% annually since the 1960s. Real estate also offers the potential for rental income and can serve as a hedge against inflation. However, it's important to note that real estate investments often require a significant upfront capital and can be less liquid compared to other assets like gold or stocks. So, what does this all mean for investors? The key takeaway is that gold, with its impressive track record and unique characteristics, deserves a place in a well-diversified investment portfolio. By combining gold with other assets like stocks, bonds, and real estate, investors can potentially enhance returns, reduce volatility, and protect their wealth in the face of economic uncertainties. Investing in gold, like any other asset, comes with its own set of risks and rewards. As savvy investors, it's crucial to understand both sides of the coin before making any investment decisions. In this segment, we'll explore the potential risks associated with gold investment and highlight the rewards of including this precious metal in a diversified portfolio. First, let's delve into the risks. One of the primary concerns with gold investment is its lack of intrinsic value. Unlike stocks or bonds, gold doesn't generate income or pay dividends. Its value is largely determined by market demand, which can be influenced by a myriad of factors, from economic conditions to geopolitical events. This lack of intrinsic value can make gold prices more volatile and subject to speculation. Another risk to consider is the potential for fraud and counterfeiting. As gold is a high-value asset, it can attract unscrupulous individuals looking to make a quick profit. Investors must be cautious when purchasing gold, ensuring that they are dealing with reputable dealers and that the gold they acquire is authentic and properly certified. Storage and security also pose challenges for gold investors. Unlike digital assets or paper investments, physical gold requires secure storage, which can come with additional costs and logistical concerns. Investors must decide whether to store their gold at home, in a safe deposit box, or with a trusted third-party storage provider, each option carrying its own risks and expenses. Despite these risks, the rewards of including gold in a diversified investment portfolio are compelling. One of the most significant benefits is gold's ability to hedge against inflation and currency fluctuations. As we've seen throughout history, gold tends to maintain its purchasing power over time, making it an attractive option for investors looking to protect their wealth from the eroding effects of inflation. Gold's low correlation with other asset classes is another key advantage. When stocks or bonds are underperforming, gold often shines, providing a valuable counterbalance to portfolio volatility. By diversifying with gold, investors can potentially smooth out the ups and downs of their investment journey, reducing overall risk and enhancing long-term returns. Moreover, gold's status as a tangible asset can provide investors with a sense of security and control. In times of economic uncertainty or geopolitical turmoil, the ability to hold a physical asset like gold can offer peace of mind and a measure of financial stability. As we weigh the risks and rewards of gold investment, it's clear that this precious metal has a valuable role to play in a well-rounded portfolio. By carefully considering the challenges and opportunities, investors can make informed decisions about how to incorporate gold into their investment strategy, potentially reaping the benefits of this timeless asset. In a world fraught with geopolitical tensions and financial uncertainties, investors often seek a safe haven to protect their wealth. This is where gold truly shines. Throughout history, gold has served as a reliable hedge against market volatility and economic turmoil, providing a sense of stability amidst chaos. In this segment, we'll explore gold's role as a safe haven asset and delve into historical examples where it has proven its worth during times of global upheaval. When geopolitical tensions rise, investors tend to flock to gold. The precious metal's reputation as a store of value and its ability to maintain purchasing power over time make it an attractive option during periods of uncertainty. Whether it's the threat of war, political instability, or the collapse of a currency, gold has consistently demonstrated its resilience in the face of adversity. One of the most striking examples of gold's safe haven status can be seen during the 2008 global financial crisis. As the world's economies teetered on the brink of collapse and stock markets plummeted, gold prices soared. Investors sought refuge in the tangible security of gold, driving its price from around $800 per ounce in early 2008 to over $1,900 per ounce by September 2011. This remarkable surge showcased gold's ability to thrive in the face of financial turmoil, providing investors with a much-needed lifeline. Another instance where gold proved its mettle was during the Brexit referendum in 2016. As the United Kingdom voted to leave the European Union, global markets were thrown into disarray. The uncertainty surrounding the future of the UK and its economic relationship sent shockwaves through financial markets. Amidst the chaos, gold emerged as a beacon of stability, with prices surging as investors sought to protect their wealth from the potential fallout of the historic decision. Gold's role as a safe haven extends beyond recent history. During the 1970s, a period marked by all-price shocks, high inflation, and geopolitical tensions, gold prices skyrocketed. The precious metal's value quadrupled between 1970 and 1980 as investors sought to safeguard their purchasing power in the face of economic upheaval. This era underscored gold's enduring appeal as a hedge against uncertainty and its ability to thrive in the most challenging of circumstances. In times of geopolitical stability, gold may not always outperform other assets. However, its true value lies in its ability to provide a sense of security and diversification during periods of turmoil. By including gold in a well-balanced investment portfolio, investors can potentially mitigate the impact of market volatility and protect their wealth from the unpredictable tides of global events. As we navigate an increasingly complex and interconnected world, the importance of gold as a safe haven asset cannot be overstated. By understanding gold's historical role in preserving wealth during times of uncertainty, investors can make informed decisions about how to incorporate this precious metal into their investment strategies, potentially safeguarding their financial future in the process. Central banks, the powerful institutions that shape monetary policy and oversee financial stability, play a crucial role in the gold market. Their actions and decisions can have a profound impact on the price of gold, making it essential for investors to understand the complex relationship between these entities and the precious metal. In this segment, we'll explore the role of central banks in the gold market and how their policies can influence gold prices. Historically, central banks have been major holders of gold. These institutions view gold as a strategic asset, a reserve currency that provides stability and diversification to their portfolios. In fact, central banks collectively hold over 35,000 metric tons of gold, accounting for nearly 20% of all the gold ever mined. This substantial position underscores the importance central banks place on gold as a key component of their financial reserves. One of the primary ways central banks influence the gold market is through their buying and selling activities. When central banks purchase gold, they signal confidence in the metal's value and its role as a safe haven asset. These purchases can drive up demand and, consequently, gold prices. Conversely, when central banks sell gold, it can put downward pressure on prices as the increased supply hits the market. In recent years, central banks have been net buyers of gold, with countries like Russia, China, and Turkey leading the charge. This trend reflects a shift in the global financial landscape as emerging economies seek to diversify their reserves away from the US dollar and other traditional reserve currencies. By accumulating gold, these nations aim to hedge against geopolitical risks and economic uncertainties, further cementing gold's status as a strategic asset. Central bank policies, particularly those related to interest rates and monetary stimulus, can also have a significant impact on gold prices. When central banks lower interest rates or engage in quantitative easing QE, the practice of buying government bonds and other financial assets to inject liquidity into the economy, it can fuel inflation concerns. As investors seek to protect their purchasing power in the face of potential inflation, they often turn to gold, driving up its price. On the flip side, when central banks raise interest rates or tighten monetary policy, it can make gold less attractive compared to interest-bearing assets like bonds. Higher interest rates increase the opportunity cost of holding non-yielding assets like gold, potentially leading to a decrease in demand and a corresponding drop in prices. The actions of the U.S. Federal Reserve, the world's most influential central bank, are particularly significant for the gold market. As the U.S. dollar is the primary currency in which gold is priced, changes in the dollar's value can have a direct impact on gold prices. When the Federal Reserve pursues policies that weaken the dollar, such as low interest rates or QE, it can make gold more attractive to investors seeking a hedge against currency depreciation. Understanding the role of central banks in the gold market is crucial for investors seeking to navigate the complexities of this precious metal. By monitoring central bank policies, gold purchases and sales, and the global economic landscape, investors can gain valuable insights into the factors that drive gold prices and make informed decisions about their own investment strategies. In the fast-paced world of gold investment, technology is revolutionizing the way we mine, trade, and invest in this precious metal. As an avid follower of the gold market, I've been fascinated by the transformative power of technological advancements and their impact on the industry. In this segment, I'll take you on a journey through the cutting-edge developments in gold mining and trading and explore the rise of digital gold investment platforms. When it comes to gold mining, technology is driving unprecedented efficiency and productivity. Gone are the days of manual labor and rudimentary tools. Today, mining companies are harnessing the power of advanced machinery, automation, and data analytics to streamline their operations. From autonomous drilling systems that can operate 24/7 to sophisticated sensors that monitor ore quality in real time, these technological marvels are enabling miners to extract gold with greater precision and minimal environmental impact. But the technological revolution doesn't stop at the mine site. The world of gold trading has also undergone a dramatic transformation thanks to the advent of electronic trading platforms. These platforms have brought unprecedented speed, transparency, and accessibility to the gold market, allowing investors from all corners of the globe to buy and sell gold with just a few clicks. The increased liquidity and efficiency provided by electronic trading have helped to reduce transaction costs and improve price discovery, making gold investment more accessible than ever before. Perhaps one of the most exciting developments in the gold industry is the rise of digital gold investment platforms. These innovative platforms are leveraging blockchain technology to create secure, transparent, and easily accessible ways for investors to own and trade gold. By digitizing gold ownership, these platforms are breaking down barriers to entry and democratizing access to this valuable asset. With digital gold, investors can purchase fractional amounts of gold, eliminating the need for large upfront investments or the hassle of storing physical bullion. These platforms also offer instant liquidity, allowing investors to buy and sell their digital gold holdings at any time from anywhere in the world. The transparency and immutability of blockchain technology provide investors with peace of mind, knowing that their digital gold is secure and free from counterparty risk. As I delve deeper into the world of gold and technology, I can't help but be excited about the future of this industry. The convergence of cutting-edge mining techniques, electronic trading, and digital gold platforms is transforming the way we interact with this timeless asset. By embracing these technological advancements, investors can potentially unlock new opportunities and gain exposure to gold in ways that were once unimaginable. However, as with any new technology, it's important to approach digital gold with a critical eye. Investors must carefully evaluate the reputation and security of the platforms they choose, ensuring that their digital gold holdings are properly safeguarded. As the regulatory landscape evolves to keep pace with these technological developments, investors should stay informed and adapt their strategies accordingly. As we explore the glittering world of gold investment, it's crucial that we pause to consider the environmental and ethical implications of our choices. In this segment, I'll shine a light on the dark side of gold mining and the urgent need for responsible sourcing and investment practices. Join me as we delve into the complex issues surrounding this precious metal and discover how we, as investors, can make a positive difference. The environmental impact of gold mining is a pressing concern that cannot be ignored. The process of extracting gold from the earth is often a destructive one, leaving behind scarred landscapes, contaminated waterways, and devastated ecosystems. The use of toxic chemicals like mercury and cyanide in traditional mining methods poses severe risks to both human health and the environment. In some regions, gold mining has led to deforestation, soil erosion, and the displacement of local communities, forever altering the delicate balance of nature. But the environmental cost of gold mining is just one piece of the puzzle. The human toll of irresponsible mining practices is equally alarming. In many parts of the world, gold mining is associated with human rights abuses, child labor, and dangerous working conditions. The pursuit of this precious metal has fueled conflict, exploitation, and inequality, leaving vulnerable communities to bear the brunt of the consequences. As investors, we have a responsibility to consider the ethical implications of our investments. By supporting companies and initiatives that prioritize responsible sourcing and sustainable mining practices, we can use our financial power to drive positive change. Ethical sourcing ensures that the gold we invest in has been mined in a manner that respects human rights, protects the environment, and benefits local communities. Fortunately, there is a growing movement towards responsible gold mining and investment. Initiatives like the Responsible Gold Mining Principles, developed by the World Gold Council, provide a framework for companies to operate in a manner that is socially and environmentally responsible. These principles cover a wide range of issues, from human rights and labor standards to environmental stewardship and community engagement. As investors, we can play a crucial role in supporting these initiatives by directing our investments towards companies that adhere to responsible mining practices. By conducting thorough research and due diligence, we can identify mining companies that prioritize sustainability, transparency, and ethical conduct. We can also support the development of innovative technologies and practices that minimize the environmental impact of gold mining, such as the use of renewable energy, water recycling, and land rehabilitation. Furthermore, we can use our voices as investors to advocate for greater transparency and accountability in the gold industry. By demanding that companies disclose their environmental and social performance, we can hold them accountable for their actions and encourage continuous improvement. We can also support initiatives that promote responsible gold sourcing, such as the Fairtrade Gold Standard and the Responsible Jewelry Council, which ensure that gold is mined and traded in an ethical and sustainable manner. As we navigate the complex world of gold investment, let us remember that our choices have the power to shape the future. By prioritizing environmental and ethical considerations, we can contribute to a more sustainable and equitable gold industry, one that benefits both people and the planet. Together, we can shine a light on the true cost of gold and work towards a brighter future for all. As we approach the end of our journey through the glittering world of gold investment, it's time to equip you with practical tips and strategies to help you navigate this exciting realm with confidence. Whether you're a seasoned investor or a newcomer to the world of precious metals, these insights will empower you to make informed decisions and avoid common pitfalls. Let's start with the basics: how to begin investing in gold. One of the most straightforward ways is to purchase physical gold in the form of coins or bars. However, before you dive in, it's essential to understand the different types of gold products available and their respective purity levels. For instance, gold coins like the American Eagle or Canadian Maple Leaf are typically 99.9% pure, while gold bars can range from 99.5% to 99.9% purity. When buying physical gold, it's crucial to work with reputable dealers or mints to ensure the authenticity of your purchase. Avoid making impulse buys from unreliable sources, as counterfeit gold is a real concern in the industry. Additionally, consider the costs associated with storing and insuring your physical gold holdings, as these can add up over time. For those seeking a more convenient and cost-effective way to invest in gold, exchange-traded funds, ETFs, and gold mining stocks offer attractive alternatives. Gold ETFs, such as the SPDR Gold Shares GLD or the iShares Gold Trust IAU, provide exposure to the precious metal without the need for physical storage. These funds are traded on major stock exchanges, offering liquidity and transparency. Gold mining stocks, on the other hand, allow you to invest in companies engaged in the exploration, extraction, and production of gold. While these stocks can be more volatile than physical gold or ETFs, they offer the potential for greater returns if the underlying companies perform well. Regardless of your chosen investment vehicle, it's essential to remain vigilant against gold investment scams. Fraudsters often prey on unsuspecting investors with promises of guaranteed returns or exclusive opportunities. Always be wary of unsolicited offers and thoroughly research any company or individual before committing your hard-earned money. One common scam to watch out for is the gold dust or gold nugget scheme, where fraudsters sell overpriced or counterfeit gold particles or nuggets. Another red flag is the gold loan scam, where investors are promised high returns for lending their gold to a company only to have their precious metals disappear. When it comes to investing in gold coins, jewelry, and gold watches, it's important to be aware of the potential risks involved. Security and storage are major concerns with physical gold investments. Gold coins and jewelry are attractive targets for theft, so secure storage in a safe deposit box or home safe is essential. To protect yourself, always work with reputable and well-established companies and never provide personal or financial information to unsolicited callers or emails. Additionally, be cautious of investments that promise unrealistically high returns or claim to have inside information about the gold market. As you embark on your gold investment journey, remember to diversify your portfolio and never invest more than you can afford to lose. Gold should be viewed as a long-term investment and a hedge against economic uncertainty. not a get-rich-quick scheme. As we reach the end of our captivating journey through the world of gold investment, let's take a moment to reflect on the key points we've explored together. We began by delving into the historical significance of gold, tracing its evolution from a currency and store of value to a modern investment asset. We then examined the intricate market dynamics that influence gold prices, including economic indicators, geopolitical events, and central bank policies. Through a comprehensive analysis, we uncovered gold's impressive performance as an investment, comparing it to other asset classes like stocks, bonds, and real estate. We also explored the potential risks and rewards associated with gold investment, highlighting its ability to hedge against inflation and currency fluctuations while providing a tangible store of value. Furthermore, we shed light on gold's role as a safe haven during times of geopolitical turmoil and economic uncertainty, drawing upon historical examples where the precious metal has proven its mettle. Our journey also took us through the exciting realm of technology, where we witnessed the transformative power of innovations in gold mining, trading, and the rise of digital gold investment platforms. Importantly, we addressed the environmental and ethical considerations surrounding gold mining, emphasizing the need for responsible sourcing and investment practices that prioritize sustainability and human rights. Finally, we armed ourselves with practical tips and strategies for investing in gold, covering everything from buying and storing physical gold to navigating the market with confidence and avoiding investment scams. As we bid farewell to this enlightening exploration, I encourage you to view gold as a strategic component of a well-diversified investment portfolio. Its unique characteristics and historical performance make it a valuable addition, offering potential protection and growth opportunities in the face of economic uncertainties. However, it's crucial to remember that gold investment, like any other financial endeavor, requires thorough research, careful planning, and a clear understanding of your personal investment goals and risk tolerance. I strongly recommend consulting with financial advisors and conducting your own due diligence before making any investment decisions. Before we part ways, I want to express my heartfelt gratitude to each and every one of you for joining me on this journey. Your support and engagement are the driving forces behind the success of Beyond the Surface. If you found this exploration valuable, please consider liking this video, subscribing to our channel, and leaving your thoughts and comments below. Your feedback and interactions are invaluable as they help us continue to create engaging and informative content that resonates with our audience. Together, we can continue to explore the fascinating aspects of our world, uncovering insights and knowledge that empower us to make informed decisions and navigate the complexities of modern life with confidence. Thank you once again, and until next time, keep exploring, keep learning, and keep shining.